So just to introduce our speakers, my name is Yarina Mujica. I work at the Natural Resources Defense Council, and I will just be kicking this off and moderating. We will be joined by Elizabeth Kelly from the Community Preservation Corporation, Kim Stevenson with the Connecticut Green Bank, and Stacie Young with the Preservation Compact at the Community Investment Corporation. And I will give them a chance to introduce themselves a little bit later, but first, let me just give a little bit of background. So NRDC and I am part of a coalition called the Energy Efficiency for All Initiative. And this is a partnership among NRDC, the National Housing Trust, Elevate Energy, and the Energy Foundation. Energy Efficiency for All works on the ground in 12 states to increase energy efficiency in affordable multifamily housing. One part of this work is to support strategies that align energy efficiency resources with the financing process. And so as part of this effort, we have brought together a network of lenders, currently mostly community development financial institutions, but also other lenders that focus on affordable housing, to share what's worked, explore opportunities for expanding and employing that knowledge. The advisory committee for this network, which if folks were on previous webinars, you may have heard a different name for this, but we are now the Sustainability in Affordable Housing Lender Learning Network. And the advisory committee for this network includes Elevate Energy, Enterprise Community Partners, National Housing Trust, LISC, the Natural Resources Defense Council, and two of our presenters today, Community Preservation Corporation and Community Investment Corporation. Over the next year, this network will be developing a suite of resources, including a website with a resource hub to provide access to case studies, best practice guides, and other helpful information for practitioners in one convenient location, a transaction database that will provide a reference point for efficiency financing transactions in affordable housing, and then this webinar series, of which this is the third in a series, we will be looking to add additional webinars in the coming year as well. So I'm going to turn it over to Elizabeth to kick us off, but before I do that, I want to put up a quick poll to the group. So you should see on your screen a question with options, with check boxes underneath it. If you could fill that out, and we will post the results up here in just a minute. Great, so here we are. We've got pretty good range here. 0% on I am very new to this topic, so that's great. We have a very somewhat versed audience. We've got a 30% I know a little about this topic, 40% I understand the key concepts related to this topic, and then 25% I've worked on this topic, and a few people that have professional expertise on this topic. So that's great. We're looking for a lively discussion with folks on the webinar. So kicking it over to Elizabeth to get us started.
Thanks, Yarina. Again, my name is Elizabeth Kelly. I am the Sustainability Manager at the Community Preservation Corporation, or CPC. We're a nonprofit affordable housing and neighborhood revitalization lender and CDFI based in New York, with offices across the state, including in New York City, which is where I'm sitting this afternoon. For those of you that are new to our webinar series, welcome. And for those of you that are returning attendees and audience, thank you for coming back and engaging in the third part of this series. Just a little bit about CPC before we get started, but for those of you who are unfamiliar with our work, we provide construction and permanent financing to owners of multifamily housing in low and moderate income neighborhoods. And over our 41-year history, CPC has contributed to the preservation or creation of over 157,000 units of affordable housing in numerous downtown revitalizations. And we also have a strong focus in improving the quality and energy efficiency of the multifamily housing stock in New York State and the communities that we're financing. As many of you are probably joining today, we are a mission-based lender, and energy efficiency is a really key component of our mission to help improve the livability and the affordability of the communities that we serve. And we see in some of you this might be a little bit of a refresher, but I promise to keep it brief. But we see energy efficiency as an excellent opportunity to improve not only the financial stability of the property of multifamily buildings that we're working with, but also tenant satisfaction and property condition. There's a lot that's going on in these buildings, as we know, and in the low-income and affordable housing space. But we're taking this opportunity to really push education internally around energy efficiency to our customers and our borrowers, but also externally, and that's why we're excited to be part of this webinar today to share some of our best practices with you all in the audience. So given the influence that a lender can have on the economics and the conditions of the building stock, we see that the finance community has this unique opportunity to really help promote the incorporation of energy efficiency and energy saving measures at the time of finance. With that in mind, we thought to create this handbook, which Irina said is available on the sidebar under handouts, and I'd encourage you all to down that kind of simultaneously as I'm giving this introduction, because it'll provide more information than we'll be able to cover today and is a really great resource. But we created that with the idea to share our best practices and some training with the industry and those involved in origination, underwriting, closing, and servicing of multifamily mortgages, technically and specifically. But we know that there's a great financing community out there. Not everybody is going to be focused, or is not everybody is providing mortgage capital specifically. And I think what you'll learn today and with our speakers is that there's a lot of similarities about just getting energy efficiency lending to happen, whether it's with mortgage financing or first mortgage, second mortgage acquisition, mid-cycle loans, solar project loans. So we're going to talk a little bit about all of that. And I do want to, before I introduce our other speakers, I just want to make a point that, again, this is the third in a series of webinars. We've covered a few topics, including understanding efficiency, which is really about the business, kind of selling the business case, building efficiency, which we talked about kind of simple retrofit measures, moderate renovation retrofit measures, and substantial improvement efficiency measures, and how to think about those and implement them as a lender. All those sessions have already been recorded and are available on the link below at the greenbanknetwork.org/webinars. You see it, and videos. So if you want more on any of those content areas, you definitely look backwards and see the recordings that we already made. So that's enough promotion, so I want to move ahead and introduce our special guests that we have today. Kim and Stacie from the Kim from the Connecticut Green Bank and Stacie from Community Investment Corporation are joining the webinar today, and very excited to have you both here. And maybe starting with Kim, can you give a little brief background of who you are and the work that you're doing, the related work you're doing at the Connecticut Green Bank?
Yeah, Elizabeth, sure, and thank you for inviting me to participate in all of this and learn along with everyone else. So I lead the multifamily programs at the Connecticut Green Bank. We're the nation's first state green bank, a quasi-public. We were established in 2011. Our overarching mission is to leverage private capital to create long-term sustainable financing for clean energy, which includes energy efficiency and renewable energy in the residential, commercial, and industrial sectors. We're financed by a surge charge on electric ratepayer bills and some other public and private sources. One of the core goals of the multifamily programs is to work to unleash and leverage cash flows from energy savings to pay for energy improvements, as well as other needed capital improvements in the housing stock, much of the affordable housing stock, which in Connecticut suffers from chronic underinvestment and decline, and we're seeing huge potential to do this in Connecticut. And we try to accomplish these goals through pre-development loans, unsecured term financing, which is mainly for mid-cycle properties, and then also solar power purchase agreements. And I'll end there for my introduction.
Thanks, Kim. And Stacie, you want to do a similar intro?
Sure. I'm Stacie Young. I work for Community Investment Corporation, and I'm director of the Preservation Compact. Community Investment Corporation is a nonprofit CDFI that provides acquisition and rehab financing to multifamily buildings throughout the Chicago metro area. We've been doing this since 1984, and since then we've provided $1.3 billion to finance 58,000 units. We really focus on the mid-sized stock and low and moderate income neighborhoods. A lot of the properties we finance are naturally occurring or unsubsidized buildings. They're affordable based on the markets that they're in. The Energy Savers program was originally launched in 2008 as a key element of the Preservation Compact, which is a collaborative effort to preserve affordable rental housing in Cook County, and of course, energy is a critical operating cost that we need to control. The Energy Savers program is a partnership between CIC and Elevate Energy. Elevate provides the energy assessments and lots of hand-holding that I'll talk about in a few minutes, and CIC provides the financing. Since 2008, our Energy Savers program has resulted in over 60,000 units receiving energy assessments, and of those, 32,000 have gone through with some sort of retrofit activity, and of that 32,000, CIC has provided grants and loans to 10,000 of those units. And that's all I have for now.
Wonderful, thank you. So this is Elizabeth again. We have a ton of experience and a lot of variety on the line today, and I will reiterate this again. You know, CPC is we're a mortgage lender. We will provide construction loans and permanent loans, and so you know, our approach and the muscle that we have to focus on energy efficiency is by integrating it into the first mortgage lending process. But we recognize that there's, you know, CDFIs across the country, and, you know, small lenders do all different types of lending operations and have many different loan products. So we're excited that with Stacie and Kim here today, we can kind of explore how a lot of the themes that are addressed in the Underwriting Efficiency Handbook can also be applied and kind of taken out of that mortgage lending context and into whichever frame of lending and parameters that you work within at your organization. So with up here on the screen now, you're seeing our roadmap to integrating efficiency, and we're going to go through this process with you today and kind of talk about some of our best practices and tips. And if you do have questions along the way, probably save most of them towards the end, but we'll be reading those simultaneously with this broadcast, and if there's something related to one of the specific measures that you'd like us to address, please let us know by entering your question into the chat box. Okay, so starting with origination. Now, I think when we talked and prepped for this earlier, one thing that is consistent throughout all of our businesses, whether it's CIC or the Connecticut Green Bank or CPC, is that there's always deal origination. And starting the business relationship and making sure that energy efficiency is a part of that can be it's probably one of the most critical pieces, because without it, there is nothing. So no matter what the lending product is, all loans start with origination in one form or another. And at CPC, what we really focus on is that while most of our owners are coming to us to finance maybe cosmetic renovations or a new roof or other repairs, we try to find ways and start a conversation that matches efficiency goals with the existing goals that our customer has brought to us. So kind of using that new roof, like financing for a new roof, as the driver to start a conversation about pushing a little bit further and increasing, energy efficiency and therefore building performance for the long term, aka the term of our loan. And so, although it seems really simple, the first thing that I tell new staff members when we're doing trainings around our sustainability process is just to ask, and on every single transaction, to say, dear customer, have you considered doing energy efficiency as part of our scope? And just kind of reading the room at that situation, and then depending on their interest and their response to that, taking it the next step further and saying we have a suite of products to incentivize this. We have technical expertise, and whatever quivers you have, you can start laying out. But without saying that at the very beginning, hey, have you thought about this? It's not really going to happen, and it seems pretty elementary, but just getting over that hump is something that we've had some challenges with, and that's really where our process starts. So now, Kim, I imagine that you're also out there doing some origination or working with a team that does. Can you share some of the approaches that have worked for you?
Yeah, sure. So one of the things that is unique about our programs is that really, rather than providing whole building financing, we're focused on the energy piece and providing energy financing, financing for energy upgrades. What we've done, and it's been key to our success, is marketing our programs through extensive outreach that's done through program partners and industry organizations, as well as a peer-to-peer network that we've established. So we didn't try to build this from the ground up. We tried to establish our credibility and work through partners that were already had strong tentacles into the industry. The other piece of our outreach is that it includes substantial technical assistance and owner education. Oftentimes, we're actually providing significant technical assistance to help owners get to a point where the quote deal is mature enough to be actually financed. So bringing them along to get to that point on both pre-development and term financing. And when they come to the table, when they come to us or we bring them in, we evaluate them, we sit down with them, and then make recommendations on which financing program, which path probably makes the best sense for them. And in addition to that, we also offer free energy performance benchmarking to any multifamily property owner in Connecticut. This is a program funded in partnership with the Connecticut Housing Finance Agency, and this is a tool to help owners identify if they have properties with high energy costs, they're energy hogs, and there's significant opportunity for cost savings from energy upgrades. So that's how we're focused.
Great. I think that segues nicely into the next piece of this, which is kind of that pre-development and portion of this process. And I can definitely speak from experience that getting someone from 0 to energy efficient can take a tremendous amount of technical assistance as well as hand-holding, and at CPC we have that expertise in-house, although it's a very small department. So as our business has ramped up around this, again, our approach has been to really educate our origination and underwriting and teams so that myself and our other sustainability professionals here aren't the only ones saying, hey, like, let's think about green, let's think about energy efficiency, but instead of having an army of 1 or 2, it's an army of several, well, a couple handfuls at least of our entire origination arm. And another piece that's been really helpful, and I think it plays into what Kim was saying about using existing partnerships and not recreating the wheel and leaning and utilizing other parties out there that have this experience. In New York State and New York City, we're really we are lucky, at least it makes my job easier. I think all of us are lucky because the city and state housing subsidy providers now require an integrated physical needs assessment, which kind of includes the components of a traditional physical needs assessment or property condition report with integrated with energy efficiency items that are typically found in an ASHRAE level audit. So you're kind of pairing this very holistic scope together, and it's a standardized document that our lenders can use to identify what the scope is going to be and how it will eventually impact cost of construction and as well as operating costs. So that's our secret for the most part. It's either using that in-house expertise or relying on these IPNAs, the integrated physical needs assessments that we have in our state. Stacie, I don't think you guys have something like that, but you're also using a third party to help support this. You mentioned your work with Elevate Energy, so can you speak a little bit more about that?
Sure. Our partnership with Elevate is critical. Elizabeth and Kim just talked a lot about technical assistance and hand-holding and how important that is. And the same is true for CIC's partnership with Elevate. Elevate gets help from utility funds that enables them to provide an energy assessment to buildings at no cost. They do lots of follow-up with those building owners to go over the assessment results and talk about what measures are most appropriate, and our loan officers, of course, follow up with a more comprehensive rehab scope. And usually these rehabs, I think you said this too, Elizabeth, at CIC, the energy work is typically incorporated into a bigger rehab job. So our loan officers use the assessment to talk to borrowers about what the possibilities are and see how the measures and costs can be integrated with the rest of the work. Elevate also helps with applying for utility rebates and incentives. they have a pool of contractors who do this energy efficiency work, good contractors. They do construction management. And so there's a lot of hand-holding that goes on, as I said, similar to what's happening at the Green Bank and CPC. And it's been key to, I think, getting these customers to say yes, which is half the challenge.
Great. I want to just jump in and, it's obviously there's nothing better than having free technical assistance and free energy assessments, but I imagine that most people on the phone would be like, I'd like to have a partner that provides all this technical assistance and is, diligent and trustworthy. And Stacie, could you talk a little bit about how would someone, how did that partnership come about? How is it funded? How would it, how could someone that might not be able to use a standardized energy report coming from their subsidy provider, get involved with this kind of a partnership that looks similar to what you have going at CIC?
So again, we're really lucky that Elevate Energy has been doing this for a long time. They're a strong partner, and our utilities are pretty much on board. I think there's always different challenges working with utilities. And just as advocates, making sure that utilities are paying attention to the multifamily stock and thinking about buildings as whole buildings and not separating the commercial spaces from the units and that sort of thing helps. I think our utilities have come a long way. Elevate, I know, actually works in different states. They aren't just limited to Chicago and Illinois. And of course, their ability to do this wonderful free stuff kind of depends on the support they get. But I would say that partnerships with utilities are really helpful. And again, we certainly have Elevate here, but we've worked for a long time and have had some success with the utilities overall in just understanding the multifamily stock, making sure that their incentives and rebates are appropriate, again, for the whole building. So even if you don't have a wonderful partner like Elevate, again, similar to what you said, Elizabeth, our loan officers are pretty good at talking about this stuff now, and it's, it takes some time to coach them, as you said. But if you can work on your utilities a little bit, that's another source of support.
I think with the pre-development process as well as with the construction process or phase, which we'll get to in a little bit, it's really critical to recognize what is the role of a lender and what are a lender's expertise and and how far can you stretch those, and where can you get support from third parties and other partners. And I think that's something that we probably toe more into green lenders, very well educated, and we do, we spend a lot of time with these deals and making sure that they're right. But other people, other lenders, they're out there originating and closing loans, getting to credit committee, underwriting it, doing their financial due diligence, and adding a second piece of reviewing energy reports and helping to formalize the scope is kind of outside of their experience. So finding partners to do that, and then also finding perhaps and funding to make that happen is definitely probably is a challenging piece of this puzzle. And Kim, I know that at the Green Bank you kind of help with that burden by providing pre-development loans, which is another great way for lenders to kind of get into this green financing space and help to encourage these projects along. Can you tell us about what was the thinking behind developing that? What did you see as where was the market need? What spurred you to create your pre-development financing package, and what does that look like?
Yeah, sure. So we developed our pre-development programs in response to barriers that we're seeing in the market that really impede the owners from funding and implementing the analysis work that's necessary to design and scope and impact and implement impactful energy upgrades. One of the things that that we see a lot is that owners kind of get bombarded by different contractors who are selling a specific solution. So it might be solar, or it might be a certain HVAC solution or something else. And those solutions may not be in the best interests of the building and may not be in the best interests of sort of a more well thought through, scoped out project that has a higher return on investment and benefits the building more over its life cycle. So that was why we really put these pre-development programs in place to encourage this deeper thinking to get impactful projects. The other barrier that we were finding is that owners often won't or can't put upfront dollars up to pay for work that has an uncertain outcome. So what we did was we developed these programs by de-risking the process, offering low-cost unsecured loans, and if a project is truly unfeasible as a result of completing the pre-development work and what gets discovered through the process, owners can petition to the Green Bank for loan forgiveness. We also have different types of owners. In some cases, we have properties with very sophisticated owners who have established contractors that they work with and energy professionals. We have other owners that are much less sophisticated. They want to do something, they want to do the right thing, but they just don't know where to start, how to begin the process, which can feel complicated and overwhelming. Nor do they often know who to turn to for trusted professional services. So what we did was we addressed that challenging by offering what we call our Sherpa pre-development loan program. This is in partnership with New Ecology, which is a national expert in multifamily housing and technical services for energy-related projects. And what New Ecology will do through the Sherpa loan program is Sherpa the owner through the various processes, helping them to scope design and arrange financing for the project. And I should note that New Ecology actually works very closely with Elevate, and they've been funded, both Elevate and New Ecology have been funded by the JPB Foundation to bring their kind of successful models to other regions of the country. So Connecticut benefited from that through New Ecology. And one final point is that one of the goals of our programs is to shift the market away from a focus on grants and free work, therefore the focus on the loans, but transitioning the market so that forgivable if necessary. One of the things that we're also seeing is that folks very much want all the free stuff from the utilities, including the incentives, and they're not taking that extra step to think, how can I go deeper and how can I use financing to leverage even higher impact on my building? So we're trying to push the market in that direction through these programs as well.
I think CPC's mission is very similar to kind of we can't imagine a world where incentives will be around forever and there'll be all this free stuff. So finding ways to kind of take a process that is, you know, what's more American than home mortgages. So and finding ways to use that existing framework to encourage and incentivize energy efficiency. And if you are here and you're like, all of this is, yes, just like Kim was saying, like, I don't know what kind of an energy report I need, or I don't know what type of level of retrofit or what kind of measures, efficiency measures might work for this, you know, a deal that I'm sourcing or something that you're looking at. Go back to our handbook, which is on the taskbar on the WebEx portal, as well as online, and I'll share the link later. We have a flow chart that answers that exact question. That kind of takes what is the property condition and the goals of financing and helps navigate pretty simply into the different categories of what kind of a report you need and what would be your next steps going forward. Speaking of going forward, we're going to move along to underwriting. And want to talk about some of the financing incentives that those of us on the phone use to promote energy efficiency. We already talked about the pre-development loans and the technical assistance provided, but there's a lot of ways that we can kind of use our underwriting, loan terms, rates, etc., to encourage efficiency to happen. So, Stacie, why don't we start with you, and you can tell us a little bit about how CIC structured your loan terms to make energy efficiency projects more attractive to your customers.
Sure, and I'll say, back in 2008, the Energy Savers loan fund was a separate loan pool. CIC, as I said, has been around since 1984. We have a $200 million loan pool, and that's how we do these acquisition rehab loans that I mentioned earlier. The Energy Savers Loan Fund was a separate pilot pool supported by the MacArthur Foundation and Bank of America and a couple of others with low interest program related investments. And so in 2008, that was the way the CIC board wanted to do energy retrofits, and it was a low-cost loan program. Since then, a couple of things have happened. One is we realized that most of the loans that we were doing for energy were also coupled with our first mortgage lending, and we also found out that the preference for those borrowers was not the self-amortizing 7-year loan program that was in this pilot Energy Savers loan pool. And so since 2008, over the last year or two, we have incorporated our energy financing into our larger multifamily pool. And this signals acceptance by our 42 investor lenders, embracing the energy retrofit financing that we've been doing as a successful program based on our strong track record. I say all that because now our program is packaged into our first mortgage pool. If borrowers incorporate the recommended energy measures, now, again, you were talking about incentives. Typically, our first mortgage lending goes up to 80% loan to value. If they incorporate their energy measures, they can go to 90% loan to value. And then the amount of the loan that exceeds 80% is put into a second mortgage. That second mortgage carries the same terms as the first. In other words, it's still a 25-year amortization, which is attractive to our borrowers, and the interest rate is the same as the first mortgage. So it's not a huge incentive, but it is an incentive, and it's something that the loan officers emphasize to the borrowers.
Great. At CPC we don't have a specific green loan product, and so most of our work are pension fund insured mortgages. We didn't, when we started our green program, we didn't go out and seek this, additional capital or additional, grant or philanthropic support to help with our work. So what we did was kind of map out, like, what is our business, both kind of operationally as well as where is the market and what does the market need to kind of help catalyze energy efficiency. And what would people really react to, and within the kind of, I don't want to say constraints, but within the parameters of our existing and loan products and these pension fund mortgages, where do we have wiggle room to incentivize this type of work? And we couldn't change the LTV limits, and we couldn't change the interest rate, but we could underwrite to the energy savings of projected performance post retrofit, and provide additional low cost long-term capital to make these projects happen. And we've tried to be really aggressive there because that's where we have opportunity. So if people that are starting to ramp this up are interested in doing a similar project, or developing a similar loan product or green loan product at your organizations, it's kind of, there's so many opportunities out there, but and finding the niche for you is definitely something worth pursuing. If you do want more like kind of a in the weeds, like how exactly does CPC underwrite to energy savings? Again, that's covered in a couple different ways in the handbook, where we go through the algebra and kind of our like a high-level approach, as well as provide a couple case studies. So look there, but if you feel like you want more information on that specifically, let us know, and maybe we can come back with another webinar specifically focused on that chunk, because I know it's been a hot topic for us so far. Okay, so we have everything ready to go. To kind of, it's almost ready for closing, and so this phase, approve and close, really has two parts. One's pretty straightforward, and for us that was just updating and creating forms and loan documents to support efficiency work, make sure that it's happening, and then we have in our handbook, we provide some suggestions and recommendations for how to update your loan documents and make changes to your loan approval process and closing process, and best practices for integrating efficiency into that piece of this process. The second part of this is more challenging, and that's about garnering institutional support. So none of this is kind of going a little meta, and like this is like more, a little different from what we've been talking about, which is kind of very process oriented. But in order to get to this approve and close an energy efficiency loan, whether it's the pre-development financing, or what CIC and Elevator working on, or the line loan at Connecticut Green Bank, or what CPC has, that you need to have that institutional buy-in, and it can be, sometimes this starts like a grassroots kind of movement, like maybe one loan officer said, hey, like, this is a great opportunity, why aren't we pursuing this? And other times it's more of a top-down decision. CPC actually started with one of our mortgage officers saying, this is really important to me, and I think there's an opportunity for CPC to explore that. And now, and here we are on this webinar today. So getting that buy-in, from our C-suite and our board and our investors and our insurers is obviously really critical, and we wanted to spend a little bit of time talking about that. One anecdote that I loved hearing, and it might have been from you, Stacie, but I'm not sure, but it was when we first brought out the handbook and we were sharing it with some of our partners. And it was someone from an organization that I recognize as having done energy efficiency lending for a really long time. And they said, this is just such a great tool to be able to go to the C-suite or the board of directors and insurers and say, this is what I'm talking about. And look, other people are doing this, and this is becoming standard practice at other organizations. And just having all this information compiled in one place has been really, it's just interesting how different organizations are using this information. Stacie or Kim, do you guys have any thoughts, comments or thoughts to share about getting that kind of buy-in and or the approval process, the loan approval process?
So I'd say institutionally, here, in 2017, this is going to be, easy is the wrong word, but I do feel like there are good, successful track records from institutions who are doing this kind of retrofit activity. So on that front, one way to make the case is looking at the others who have been successful. And 10 years ago, that wasn't necessarily the case. But I will say, you know, at CIC we've been doing this for 10 years, and it's a continuous process. I think we've got great buy-in from the top levels, and you know, we're constantly making sure that this is on everyone's radar. We've got, you know, just down to brass tacks, we've got energy and water efficiency, you know, in our different checklists on our application, in our contractors' sworn statements. Just sort of keeping this on everyone's radar all the time, even though we've had this program for a long time. You know, you got to try keeping it fresh and at the top of everybody's mind.
Absolutely. Great. So now the build process, probably, you know, after that origination piece, well, and the pre-develop, I mean, everything's so important. It's hard for me to say, I keep saying this is the most critical piece, but this might be the most critical piece. Building and, you know, coordinating with the borrower, engineers, and the construction team to confirm that all the efficiency measures are installed correctly and operating as designed. So you have, you know, the project is papered up and the loan docs are signed, and I really think this is just the starting line, and making sure that all of this, all the energy efficiency work that you scoped for, that the borrower scoped for, and that you as a lender underwrote to or provided, you know, better loan terms to incentivize, and making sure that that work is properly installed is still a challenge. And as I said with the pre-development piece, it's kind of understanding, like, what is the role of a lender? Where can we seek outside support? What processes are already set up in place? Like, we have a construction lending arm and of kind of asset management for our construction managers, or for construction managers. So that's where we focus, and making sure that when requisitions are coming in, that the efficiency scope is also being looked at and made sure that it's completed before making those kind of advances. Kim, what kind of process do you have over at the Connecticut Green Bank? I think you're probably also using third-party engineers, but can you tell us a little bit about how that works for you guys?
Yeah, sure. So we have a third-party architecture and engineering firm that actually does the energy underwriting to confirm that and the modeling to confirm that the projected energy savings make sense, and those are the numbers that we use to underwrite the loan. And then that same firm will go out and review the construction work and review progress payments as the work gets done. For projects that include both efficiency and renewables, we've adopted the AIA certification and documentation process. And then for our solar projects, we have experts in solar installations go out and review those systems and make sure that they've been installed correctly.
Great, it's pretty comprehensive. I think so. The last part of our process for integrating efficiency is loan servicing, and or maybe this is more, you know, considered asset management at your organizations. But after the construction, making sure that these components in the energy efficiency systems, especially anything relating to HVAC, are operating as intended, and that the utility expenses are in line with what the project was, or what the building projected to do, especially if you underwrote those savings or have you know, provided those different loan terms to incentivize this work. So, you know, one way to do this is by doing energy benchmarking, which we talked a little bit at the beginning of the presentation about, Another way that, is maybe more of a baby step, but if you're collecting income and expense reports from your borrowers on collateral, then using that as kind of a way to ballpark what expenses are. But I think energy benchmarking is definitely the crown jewel of M&V and reporting and verifying energy savings. But it can, it's not always possible, and it can be expensive. So that looking at the income and expense statements is just one way to kind of one way to get a foothold without going full into a benchmarking program. But Stacie or Kim, we're pretty short on time now, but do one of you want to talk about how you both require energy benchmarking as part of your loan terms for your term loans? You want to talk a little bit about how you set that up and how that's being funded or who's paying for it? People always want to know that.
Sure, this is Kim, so I'll take it really quickly. So I would say on the front end, we encourage benchmarking as a first step to really just orient everyone on what's the building energy performance. Right now, as I mentioned before, we offer free benchmarking. We pay for that. The Green Bank pays for that in a partnership with our housing finance agency. And then in terms of the term loans, we actually require performance monitoring for the duration of our term loans. And right now we have plans to provide quarterly reports to owners whereby they'll get a report each month that shows what the actual performance in terms of cost and energy was versus what was projected. And I think you would asked also a question about earlier about data and who gets to use the data from the benchmarking and the information we collect. So data is a very sensitive thing. So if we're funding the benchmarking, we have access to that data as well as the owners. But we don't share that with any other energy professionals or contractors without owner permission. So that's kind of how we handle the data issues.
Great. And another important piece of kind of loan servicing or asset management is definitely making sure that there's an operations and maintenance plan in place, and resident training and education around how systems work, and extending that to the building staff as well. We don't go into that too much in our handbook, but there's plenty of resources available and checklists and protocol manuals. I think Enterprise and their Green Communities kind of portal on their website has a lot of great resources. And I know, Kim, you at the Connecticut Green Bank are either in the process or soon to share some of those that are similar. I think that's correct, right?
Yeah. Yep.
Great. Well, if that was I mean, it's an hour, but it all went by very fast for me. We, in the handbook, we have all of these sections we have much more detail. We have this, a checklist that kind of helps you kind of move along through this process with some really great things to consider along the way. We have a couple more slides, but I just want to remind everybody that if you have any questions, please send them in the chat box, and we'll try to get to them today. And if not, we can follow up later and dive into any questions in more detail. The other piece I wanted to point out was that in the handbook, there's a ton of tools that are available. Like we have a back of the envelope benchmarks for buildings in New York City and in the Northeast. We have a section on how to decode an energy report. We have a ton of case studies, measures of efficiency, or checklists full of efficiency measures to kind of get an idea of what is energy efficiency and what types of measures and investments should I be doing in buildings, as well as tips for implementing retrofits. So even though I said it 8 times already, if you haven't done it, try to download this handbook and skim through it, and there's probably going to be something that will relate to you in your business, and if not, just a lot of food for thought in there. So that is the end of our official presentation. We have all of our contact information up here. We're so glad that we were able to share this with you today, and thank you to those of you who participated in multiple sessions of this series. And I think Irina has some closing thoughts and an exit poll for you, so I'll pass it over to her now.
Great. Thank you so much, Elizabeth, Kim, and Stacie. That was really comprehensive, and I think you packed a lot of great information into this session. I'm going to put the poll back up on the screen. If people could just take a minute to fill that out. Again, we will show the results on the screen in a minute, and just sort of close us out from there.
And while that's happening, I think if there's pieces of this that you thought like, oh, I'd like to know more on that topic, I'm going to butcher the name of our group now, but the Sustainable Affordable Housing Lender Learning Network. We really want to be doing this more often and finding other speakers, or if you think you have a topic that would be great for this group, please let us know, because we want to continue doing this and sharing resources and expertise with the greater network.
Yes, absolutely. Thank you for mentioning that, Elizabeth. So poll results are in, and it looks like we definitely moved some folks from knowing little about this topic to understanding key concepts. So that's great, and also we're up to 50% of I have worked on this topic. So that is a great result, and I do want to just reiterate Elizabeth's point that if you do have any questions that you think of after this session, please do feel free to reach out to myself at the Sustainability and Affordable Housing Lender Learning Network. If you have thoughts about other webinars that would be of value, we are actively planning out our sessions for the coming year, so we would welcome that. And if you have specific follow-up questions, please do feel free to contact any of us. Our email addresses are on the screen. So with that, thank you all for joining, and we hope to engage with you on another webinar soon.